But when you start doing like multiple personal cars, family vacations, vacation residences, your home expenses like your landscaper, things like that, all of a sudden those aren't applicable to business. And you've actually hurt your value on sale. You have made it harder to keep positive cash flow in your business. You made it harder to get a loan from a bank, and you put yourself at risk of getting audited and getting slapped with a penalty. So it may feel great in the short term. In the long run, if you want to run your business well, it's not a good idea.
Welcome to the Flywheel Effect, the podcast where ambition meets expertise in the world of luxury home services. Whether you're an entrepreneur, a small business owner, or a forward-thinking professional, this is your platform for growth, profit, and prosperity. Each episode, we dive deep into how to leverage data for smarter business decisions and share insights that help you transition from technician to visionary. Let's jump in.
Hello, and welcome to another episode of the Flywheel Effect, brought to you by Vital. I'm Brent Sonnek-Schmelz, your host, along with my co-host, Matt Bernath. Matt, how are you doing today?
Hey, Brent, doing amazing. Really awesome day. Finally starting to feel like fall here in California, which I'm ready for, and looking forward to the snowboarding season.
Amazingly, it's not feeling like fall in New Jersey yet. It has been 70 degrees every day.
Wow, that's incredible. Yeah, it's like 60 max this next 5 days here in California.
Yeah, it's been 70 degrees, and it hasn't. I mean, we're taping this early November-ish. It hasn't rained here in like 6 weeks.
Wow.
We got this California dry, warm 70s weather rolling through every day.
Yeah. It's probably nice for a lot of you, except for I guess the fires, right? It's not been great for the fires. I guess you guys need some moisture out there to help with that.
We never have fires, but we do now. It actually put a fire moratorium in our backyards, which I've never ever seen before.
Wow, that's wild.
It's wild. So hopefully we get some rain. Hopefully we get some. I'm ready for ski season too. You're a snowboarder, I'm a skier. We should probably go sometime.
Yeah, absolutely. I'd like to go up to your place in Vermont.
That would be great. And I know my wife would like to come out and go to Mammoth, so we can do either.
That's right, of course.
So that'd be fun. All right, here we have an interesting conversation today. We've had a little bit of interesting conversations online about the entrance of institutional investment into our integrator space. And I think there's been a little misunderstanding, a little need to kind of educate and talk through what we're actually looking at and why. And I think, at the end of this, we should have an interesting spot where you can understand why this is happening, what we're looking at, and how you can make your business more successful as a result. So Matt, you and I have spoken about this a lot. I think we look at, and most people know Bravis originally was all Vital members who joined that. And that was the first big one several years ago. And now we're looking at others, whether it's Daisy, High Solutions, that are bringing in a level of professional investment, and I'm going to specify terms in a little bit, into our integration space. What are you seeing out there or hearing?
Yeah, this is great. And before we dive too far in, I'd like to clarify, there are a number of people that I still run into that don't understand the connection between Vital and Bravis. And I want to clarify that. So, Vital was actually, the brand Vital was built on a platform. Steve First had been teaching to integrators across the country for years. And essentially, it was an operating system, or is an operating system for custom integration businesses, right? Helped to create 28 metrics. And then, of course, there's benchmarks and management efforts that go behind all those metrics. So that system had been around for a while. Paul Starkey, who's another industry legacy, had met Steve and said, hey, you know what? We can probably use your system as the foundation for what would end up being the only successful roll-up in our industry. Roll-up meaning, multiple independent dealers rolling up into something larger. So they created this platform called Vital at the time, really with the intention of creating a roll-up. That's what it was intended for. And they offered that solution to multiple integrators, and eventually 15 of those integrators went through the whole process. And it was quite a process. I think it was, for some of them, it was at least 3 years of getting this business operating system in place before they could take part in the roll-up. So that roll-up happened in 2019, and I believe, and Brent, you can correct me if I'm wrong, I think it was 15.
About 15.
Yeah, about 15
Yeah,
original dealers. And what made this the primary reason this was successful is because all of these dealers were on a very similar operating system. They had similar software. They had the same financial metrics. They were running their businesses very similarly, and they were all really profitable. So that's kind of the Vital connection. Once the Bravis roll-up took place, Vital and Bravis completely disconnected. Vital still teaches the same foundational operating system, but has no connection, to Bravis. So just kind of clarify a little bit of that as to, the connection between Vital and Bravis. The reason the Vital method works so well is because it is, it's widely accepted practices across, private investors and private businesces.
Yeah, I just want to even one step further. Bravis is not a Vital client.
Right.
Right. And it hasn't been for years.
Correct.
So that's great start. So let's now, thanks for the clarification. That was good. That, I think, past some others, was really the first understanding Bravis, and this could segue into this. The first entry of what we call private equity dollars or investors into the integrator space. On the integrator side,
yes,
there's been plenty of acquisitions on the manufacturer side. I think that's a little different market. But the integrator side, small local businesses, Bravis is the first one I think has had decent success. There's Via and a bunch of others that didn't work out. But I think it's kind of shook up the industry a little bit, right? People didn't know what to make of it. You were an integrator at that time. What were you hearing, and what were the fears and what were the concerns when people saw this happening?
Well, I had actually sold my business a year prior.
Okay.
I sold my business in 2018. I still had my security company, so we were adjacent to the integration space. So I couldn't tell you directly what some of the fears were, but I think they were similar to what we're experiencing now, except there are some more public entities coming in. Public meaning, a lot more marketing and PR and making a bigger splash. Where I think the Bravis thing didn't make as big of a splash when it happened in our industry. And I think also it happened so closely to some of the other failed ventures that people sort of thought that it was going to fail. I think now that they've seen Bravis succeed in some ways, the industry, and this is just my opinion from observation, I believe that there's now a sentiment that like, hey, these things could work, and maybe that's why there's some fear around some of the new entrants. Plus, again, the new entrants come from other spaces where they've been successful doing the same thing.
Yeah, I think that's exactly where it was. It's like I think the fact that Bravis has survived for 5 years has given some people some notice that these things can work. And one of the reasons why we're really doing this podcast today is you and I have seen, half a dozen at least of investors that we know coming into this space. You go from Daisy, I think High Solutions has some money, and there's a bunch of others that are silent and private now that we're going to see pop up in the next few years. And I think in any industry, when you see, and I think this is a good opportunity to go into some definitions, but in any industry, when you see this institutional money coming in and you see one or two instances of it, the industry exists with lemmings, right? They follow. So when they see one or two people be successful or other firms, you're going to see more, and they're going to see more, and they're going to see more. So they are coming. This is not a situation where we can fight institutional money. What our key is, how do we make it and use it to our advantage so the people in our industry get the best possible outcomes as a result of it being here?
Yeah,
right?
Absolutely. And when you say we, you're taking the perspective of the independent integrator, which is who we work, who Vital works for. And I think then you're also taking the perspective of the industry as a whole, right? Which might even include manufacturers, because they play into this picture as well.
Absolutely. I'm doing, yes, these are collective we's. Basically the collective we of everybody who attended CEDIA over the last 5. If you have attended CEDIA for more than 3 or 4 years in a row, you are included in that collective we that I re-referenced. Right?
Yep.
If you just showed up last year to invest, you're not included. That's a different story. So I think, Matt, we mentioned, hey, Brandon, you should probably get into some definitions. I think in our pre-call you said that.
Yeah,
So
I did. And I want to ask just real quick before
Sure.
you go into that, I want to ask a question around, you brought the lemming situation they follow. So,
Yep.
so the they you were referring to are these institutional investors, right?
Correct.
And so explain for our listeners who maybe some of them don't have any experience with that side of the world. Explain a little bit in it's pretty simplified terms how they make money. Why are they doing this? Why do they follow each other? Like what's the why behind all of this for those institutional investors from general perspective?
Okay, so let's start really high level. These institutional investors, as we'll call them here, they have another term, alternative investments. And what are they alternative from? From basically the stock market. So you have public equities, and you have privately held investments. Public equities are stocks, S&P, all that stuff. Everyone, which most people know, can trade on E-Trade. There's this whole other universe of investments that's only available to high net worth people and institutions like pension funds or high net worth family offices that want to change their return profile. Whether it's positive or negative, different story. And you've probably heard the terms in the market: hedge fund, private equity fund, venture capital, real estate, private equity, all of these things. And all they really are is vehicles or ways to invest money in deals that are not publicly tradable. But taking that as a frame, it can be sliced a little bit more. Private equity, which you've all heard, I think, maybe you haven't, but so private equity is essentially a pool of capital from rich high net worth people or institutions that's committed to investing in private companies, typically by using debt and equity as a combination. So they buy existing companies that are profitable. The profitable part is really important because that's what helps pay for the debt going forward. So the debt goes on the company itself, not on the fund.
So stop there, Brent.
Sure.
And I'm gonna, I know
Please.
you're used to talking about a lot of this stuff at a different level than maybe some of our listeners. And
Yeah.
I don't want to assume any level of our listener. We got all kinds, right? But I think what's important is when you talk about the debt versus equity, explain how that works a little bit. What's the difference between debt and equity as these PE deals happen?
So think of it like when you buy a house. This is the perfect example. It works exactly the same way. You buy a house for, call it, let's say $500,000. But you're able to do that not because you have $1 million in your $500,000 in your pocket, but because you have $100,000 in your pocket, and you're going to put a 20% down payment on it. You put 20% down, you finance $400,000. And why do you do that? Because it allows you to gain a lot of additional equity in this house. Or like you're paying your mortgage, say it's $2,000 a month, and you're paying that off, some of it's debt, some of it's equity, and all of a sudden, over the next 10 years, you've built that equity into your house by essentially paying rent to yourself to be $250,000. So now this $500,000 house, which hopefully is worth $600,000, you have $250,000 or maybe $350,000 in it because the debt stays the same. So now you have $250,000 worth of debt, $250,000 worth of equity from the old value of the house, plus $100,000 of new equity. So you turn that $100,000 over the course of 10 years into $350,000 if you sold it then, which means you got 3.5 times your money, right? Your money, your house, the fact that the house of your value of your house went up $100,000, all accrued to the equity that you put, your down payment, so that now your return is not 20%, but 350%. Private equity is the same thing. They're buying a business, an asset. House is an asset, business is an asset, for a certain amount of money down, equity, call it 20 to 50%, a certain amount of debt, over time paying down that debt, building the equity, and then hoping the company increases in value, and that's how you generate a return. Was that a good explanation, Matt?
I think it was. Yeah. Thank you for grounding that. Yep.
It's nothing. It's no different.
I think it's a great way for people to visualize debt versus equity, even if they're not dealing with private equity investment, if they're selling to another entity or whatever the case may be.
Yeah.
I think it's important to understand the debt versus the equity piece when you're selling your business. So thank you.
The flip side of debt, though, is that if you go underwater and you over leverage or the value goes down, you can lose all of it. And I think that's what happens with private equity sometimes, is they maybe get too aggressive, which people see these because that ends up being a big press release or an article. Such and such company goes bankrupt, bought by private equity. You saw that with Sports Authority. You guys may know. Sports Authority went bankrupt because it was owned by a private equity firm who didn't grow. So just that, I want to give you that frame. And it's like, hey, just like a house. You saw a lot of people lose their houses in 2009 because they had too much debt on the house and they couldn't make the payments.
Absolutely. Yeah.
So that's private equity. So they look at existing businesses often. And that is where you're going to see a lot of play in here. There's some other opportunities, though. There's this other component which people mix up a little bit with private equity called venture capital. What's venture capital and how is it different? Venture capital doesn't really invest debt. They're investing equity in incredibly risky ventures, expecting to lose money on maybe 9 out of 10 of them. But that one that hits, they're going to make 10 to 100 times their money, and it's going to take over the return profile for everything else. You think of venture capital as being the companies that fund Google, Facebook, Airbnb. Those are all venture capital deals. But
they're looking for the unicorns. Basically.
They're looking for the unicorns, or they call unicorns is now passé. It's now about the gigacorns, right? Like they got to be even bigger. But they also play in a little different space. They can fund a startup that they, and this is maybe a little bit different private equity, that they may view a lower risk profile because it's going to start building cash flow quicker, but that it's going to transform an industry in a way that they think they're going to be able to take advantage of. The timeline is different too. Private equity, they're looking to get out of businesses 3 years, 5 years, maybe 7. Venture capital will hold their investment for 7, 10, 15 years to try to maximize the return in that single investment. And they're different, right? But both can see interest in our industry, which is really interesting. You don't always see that. And I find it intriguing. Like what is it about our industry that makes this attractive to both types of private capital? We can explore that a little bit, but it's actually something to be kind of proud of. Like, hey, we're good enough for both. Wow, that's really interesting.
Yeah, it is interesting. And thank you for explaining the difference, because I think that's a very significant. The risk profile is different, their expected returns are different, and their timelines are very different, right?
Yeah, and their strategies are totally different. Like they look at value in a different way. One is consistent, regular, repeatable cash flow. The other is maximum growth and value and ultimate equity valuation. They're going to come at this very differently.
Yeah.
There's lots of other kinds of capital. There's high net worth. There's family office. There's whatever you want to call it. You don't have to. If anyone's gonna, we don't have to go into that too deep. Anyone want to go through it deeper with me? I'm happy to have that conversation privately.
Yeah, and I think the primary goal of our conversation today, I think, is twofold. One, education, right? Get a lot of the information out there into our listeners' hands, whether they're in the custom integration space or any other luxury home service. You and I have seen a ton of activity in investment in home services broadly,
yes.
Right? So it doesn't matter what home service you're in, you really need to know this stuff. So the goals today are twofold. One is education, and two is to really determine how, if you're an independent luxury home service provider, how do you maximize your opportunities to be on the right side of really the maturation of home services, which is what we're seeing. So you brought up earlier, hey, this is a train that's left the station. It's not going to stop. I think
Correct.
we believe that. I don't know that me or you or any of us have any effect on what's going to happen there, right?
No, none at all.
But what we can do is we can educate ourselves, we can educate each other, and we can put ourselves in a position to win. So you started to go into some definitions, and I'd love to hand that back over to you, and I might have some pointed questions as you go through them. So give it a shot.
So I think it's one. Let's look at some valuation questions. Like how are these businesses looked at, and why are they intriguing? Now, maybe the why, we should start with looking at other industries first. Look at home services. We have, and think of the home service. You might have friends that are in this, whether it's fencing, HVAC, roofing, HVAC is really hot. Roofing's pretty hot. Plumbing is hot. They all have been targets in the past decade from private equity funds of various types in doing something called a roll-up, which is buying a core business that's profitable, probably has a good name, has a good organization, and then adding on additional acquisitions quickly. And why do you do that? Well, you have a foundation, you're able to buy it for a certain amount, and then adding these on, the goal is they're going to buy those add-ons for a little bit less on a multiple basis, and define multiple as a multiple of earnings or EBITDA, earnings before interest, taxes, depreciation, or amortization. Flip side of that's something called SDE, seller's discretionary earnings. But let's just call it earnings, maybe 3 to 5 to 7 times. Put it together in a larger entity, and when they're added, and all of a sudden the earnings went from $500,000 to $10 million. Now they're able to value that at 10 or 12 or 15 times earnings and get this earnings expansion and just grow. So they're incentivized to buy as many of them as possible without breaking the organization, right? So that's how a roll-up works. Right now, there are at least a dozen of them happening in HVAC, a dozen of them happening in roofing, growing from $10 to $100 million in revenue. And all these private equity firms are now fighting for deals in those spaces, all these other home services. And so their mind is, wow, all these home service businesses were doing great. What other home services are out there that maybe haven't been targeted yet? And that conversation, which is, where do we find deals that are not currently have huge amount of competition, which is what they're doing every day, leads them to home integration. I think home integration is one of the few home services business that has not seen the roll-up bonanza.
Yep. Good. I love that explanation of why they're doing it and why they're following each other and how that works. I think that's really incredible. And it's important for our listeners to know that, right? Because once they know and understand the motivation of what's happening in the marketplace, they can better position themselves to win.
So there's a couple other points that I think I didn't bring up. On the operations side, they also tend to improve operations. And what do? They bring in systems, professionalization, they ramp up marketing, and they build a business with what, as we often talk about, the systems and procedures in place that allow it to scale. So, and honestly, if you already have those things, you are then a lot more interesting to them for an acquisition because they don't have to do as much work once they buy it.
Absolutely. Yeah. So let's talk about that in a moment here, but I do want to give you just a couple of minutes to go through some of sort of the definitions or the things that you think are important for our listeners to know about as we talk through these concepts.
So, well, I defined private equity, defined venture capital. EBITDA, I'm going to do EBITDA and SDE because I think that those are really critical. EBITDA is your earnings for the company that, and the way they look at it, is adjusted and normalized for ongoing operating business. And how are you doing as a percentage relative to your revenue? I think you guys people all look at net income and all that, but they include some things that don't really apply, like taxes. Taxes are something that is not part of the valuation discussion. The earnings before interest, taxes, depreciation, and amortization. So before interest, before taxes, before depreciation, amortization, which are non-cash, allows a business to see how is this company operating. And what an investor typically wants to see is a company that's generating at a minimum 10% operating. Why does that matter? The reason that matters is if you're putting debt on the books, or you're putting these operational changes in place, the company can cover these other expenses that are necessary once the acquisition occurs. So 10% is like the minimum. If you're doing 15 or 20, your business is worth even more because you're reducing risk. So having a business that's profitable and functioning and operating as a go forward business, as opposed to just a person, is what makes it attractive. Now, and SD.
Well, sorry, I want to highlight something real quick there that you said that
Sure.
that I think is potentially a misunderstanding from some of the conversations I've had with independent dealers.
Okay.
So you brought up the fact that as you raise your, and I'm just going to call it net profit because that's how a lot of people refer to it, but it's EBITDA. If you raise your net profit from your net operating profit from 10 to 20%, you said your company is more valuable because there's less risk. So not only is your company more valuable from a dollars perspective, meaning there's a higher dollar from which you get multiplied, you also have the potential to increase your multiple because your multiple is a function of the risk involved, right?
Correct.
So it's almost like a doubling effect. When you go from, for example, 10 to 20% net operating profit, you're increasing your bottom line from which your multiple is calculated, but you can potentially increase your multiple itself.
That's
right?
correct. That's correct. So on the same million, let's call it the same $5 million of revenue, right? If you're a 10%, you're making 500,000. If you're a 20%, you're making $1 million. That $500,000 profit business is probably worth $2 million bucks. Thereabouts.
That's high. That's probably on the high side.
That's probably a high side.
Yeah.
Call $1.5 million 3 times. I was being generous, but yeah,
Of course.
you call it, don't hurt anybody's feelings. On the $1 million business, now that could be worth 5 times or $5 million. So by doubling your profit margin from 500,000 to $1 million on the same revenue, you just essentially tripled the size of the value of your business. So, and I think the difference between 1.5 and 5, as far as life-changing money, is huge.
Absolutely. Yep.
Huge.
Absolutely.
And I think there's a recent article on this in the Wall Street Journal about all these kind of the millionaire next door, they called it. It's all plumbers and carpenters who are selling their businesses for real money to institutional investors. And it was, I think, talking to a few people, it was eye-opening, right? Like, wow, this is actually happening. I can have this exit. That's exciting, right? But the key is you got to run a good business. You got to run a business that's designed to be able to be run by somebody else, that is growing moderately. It doesn't have to be huge growth, but you have solid growth and has metrics, profitability metrics that are appealing. And now you're of interest. But by the way, you also run a better business. You have less stress, and you had a better time doing it. So it's a win-win all around.
That's the TLDR right there. You don't need to listen to anything else in this podcast except for what Brent just said. It's literally that last section is 100% it. But anyway, kidding, of course. We got still plenty of value to drop here.
Yeah,
but that's the big news.
The best part about running a business that people want to buy is that you're running a great business.
Yep, no doubt. And that sounds easy. It's not easy. That's what took the original, Vital members that got bought by Bravis. That's what took them 3 to 5 years in most cases, right? It's hard work. It's a long-term play. But boy, when you calculate the difference between what you just brought up, selling for $1.5 million or $1 million and selling for $5 million, if it takes only 3 to 5 years to get there, that's massive, right?
Yeah.
So anyway, I sidetracked us a little bit. You were going to go into SDE. Go ahead and
Sure.
talk us through that.
So sellers' discretionary earnings is the way that is what people look at that are buying businesses, typically among people. It's if you're like, there's this whole universe of, they call it self-funded searchers. It's another kind of small, stupid, silly thing. But it's people who have decided that they're going to go and buy a business and run it. And what they look at, and then they typically buy it with debt. They buy it with an SBA loan. SBA, we had another session about SBA, and you should learn it. SBA is the Small Business Administration, which provides backing to loans for people to buy businesses and run them. They look at SDE. SDE is different than EBITDA because it includes the salary that you receive as an owner. Like seller's discretionary earnings, you have a choice of what you're taking out of the business. So the profit plus what you take out for yourself counts as seller's discretionary earnings. And that's essentially what most integrators are dealing with. Hey, the money that you take home or that you think is yours to spend, however you're going to spend it, is considered seller's discretionary earnings. And when you're selling to each other, that's the key metric. That's what you use to determine the value of it. And again, it's a multiple, a few times multiple gives you the value of the company. And I think it's not how private equity or even venture capital look at it. It's how the small acquisition entrepreneur looks at it, which are also coming for us. They came into roofing, they came into fencing, they came into HVAC, and a bunch of others. They're seeing this, and I've spoken to a bunch, seeing this as a really interesting place, and they're going to buy. Their goal is to buy one good one, and hustle and work, make it better, put in systems and structures, make it more profitable, buy one or two more, and then potentially sell it off. But they're going to be really good competitors. You think, oh, these guys don't know the industry. Yeah, they don't. But you know what they are? They're hustlers. And if you got some hustle,
business people.
They're business people. You got some hustle.
Business people.
You know what you're doing? You could be successful. None of this is rocket science, right? Like our industry is not complicated. It's not that it's not complicated. It's not more complicated than other businesses.
Yeah. I think there's some really good points you just brought up. There's a few of them that I want to hit on.
Sure.
One, just since I've been in the industry, which is just under 20 years, I've seen multiple outsiders come in, buy integration businesses, and either continue to do really well with them or have exited in a very significant way. Mm-hmm. I've seen all of it. So I currently know of at least a handful of, we'll call them outsiders, people that did just what you just described, purchased a business having no experience in the industry. A number of them that are still doing really well, and also a number of them who've grown their businesses to the degree that they could sell them profitably. So that's a thing. But also, it's something that sellers' discretionary earnings, I wanted to kind of riff on a little bit more there too, because there is some nuance. Mm-hmm. There is a replacement cost for the work the owner is doing. And so I think as you've described it, you can add back in the owner's salary to the degree that owner is not needed in the business.
Correct.
Right? So for example, those businesses which describes a lot of integrators and a lot of luxury home service businesses, they need the owner in order to operate, right? Mm-hmm. The owner's the main salesperson, the owner's the main project manager, or the owner wears 6 or 7 different hats. So in that case, the owner's salary cannot be added back in because the owner is needed to run that business. Mm-hmm. But if that owner has built a business where they are not needed or they're easily replaceable, mm-hmm. then that salary gets to be added back in, right? Mm-hmm. So that goes back to your comment a little while ago about, hey, run a business that can be sold, happens to be a great business to run. That's key, highlight. Also, seller's discretionary earnings includes there are a number of add backs. And so that's another definition I think is important for us to bring up. Add backs are those things that are owner's perks, right? And that might be a leased vehicle that the owner, would take with them, of course, as they leave the business. That could be additional bonuses, benefits that are paid, below the line or in the P&L that mm-hmm. are owner's perks. So just a few things for people to keep in mind as they're looking at that sort of seller's discretionary earnings piece.
Well, let me add an important nuance with the owner's perks, though, is that if you commingle, which is a term, mixing assets and income too much between your personal and your business, you could undermine your entire earnings because people won't accept it all as add backs. And sometimes they're going to ask you to write a check to pay it back because it was not necessarily a legal expense according to the IRS. And therefore, they don't want to be on the hook for it if the IRS comes looking. I actually, in a former life, when I was actually working in private equity, there was a deal that the company was acquired, and he had his, I think it was a Lake Tahoe house or something on the books of the company. And the buyer, the private equity firm, at closing says, look, we found this. You got to write a check for $750,000 to buy this back properly so that that's not a problem. And Hamilton Hart almost killed the deal. Ultimately, he wrote the check. The IRS audited him the next year, okay? And primarily about this house. And they were going to throw the book at him. He handed over the cash check, and he walked away scot-free.
Yeah.
Like literally, that's true story.
Yeah. And tell me why, Brent, many people, many small businesses commingle personal and business. What do they think the upside is there?
They think they're going to pay less in taxes.
Well, why do they think that?
Because they do for a period of time. They get to and personal expenses otherwise are after tax, right? If you're paying yourself income and you're going to spend money on a boat, that's an after-tax purchase. Mm-hmm. If you have it in the business and you expense it, it's pre-tax. It's still personal because you're the only person using it. So they think they're getting away with something. Look, everybody does a little bit. Extra dinner here or there, whatever. You put your wife on the board or husband on the board. Let's be at least a little, good. You're going to go out to dinner, you're going to charge back. You know what? I'm not going to worry about that. But when you start doing like multiple personal cars, family vacations, vacation residences, your home expenses like your landscaper, things like that, all of a sudden those aren't applicable to business, and you've actually hurt your value on sale. You have made it harder to keep positive cash flow in your business. You made it harder to get a loan from a bank, and you put yourself at risk of getting audited and getting slapped with a penalty. So it may feel great in the short term. In the long run, if you want to run your business well, it's not a good idea. Or if you've done it and you want to change, you can unwind a lot of stuff over 3 to 5 years, and then you're going to be fine. But just kind of be aware. So Matt, I think a lot of this angst that we're hearing out there gets into the fact of people, hopefully cleared up a little questions that people have. But I mean, the whys of this is what scares people, right? Like, why is this happening? How is it going to affect me? What's going on out there? What do you think, Matt? What are the whys that you're hearing?
In terms of the why an independent luxury home service company should get involved with this, why the private money's coming in, what do you mean why?
Sure. Let's first say, why are they coming in? Because people don't understand, why are they coming in, and why do I think, and I think you think, that they're going to have some success?
Right. So it seems like the why that they're coming in is there's a bunch of money on the sidelines, right? I mean, there's a whole bunch of investment money out there. And like you said earlier in the podcast, they're looking for alternative investments. They're also following the path of success that has been cut through other luxury home services. And we're talking specifically about custom integration because that's one of the luxury home services that hasn't yet, other than the One Brabus deal, hasn't really been penetrated, in the last 10 years, let's say, from institutional investors. So I think that's the why for them. They want, they want to get a good return. I mean, they're investors, right?
Yep.
I think the why for the independent dealer or independent business owner is, this is that sort of tipping point, if you will, to maybe motivate you to improve your business. Because ultimately, the best way to compete in the marketplace, in a marketplace with a lot of consolidation, is to run a really healthy business. When you run a healthy business, you have the potential opportunity of getting acquired by one of these, institutional investors, which you may or may not be interested in, but at least you have that option. And when you have options to sell, that typically means you're going to get a higher valuation than if you don't have options, right? If nobody's looking to buy you, then there's not sharks in the water, right? There are not people bidding on your business.
Yep. And let's talk about reality of that. I think everybody believes their business is saleable. If you look at the history and the data around integrators historically, a shockingly small number have sold for anything that they would consider a decent number. Best case for most is have some payout over time when you hand it off to your best tech or your son, and it just kind of rolls and people are making money. But there's not a majority of firms aren't able to do that. There's maybe not a tech. There's no child in the business. So what is the result? You run it until you say, hey, thanks for 40 years of service, market. Appreciate all your time. We're going to retire now and go on with our lives. So you get zero. Your company ends up being worth zero. So having this opportunity to sell, if you run a good business, is hugely positive.
Yeah, that's one piece of it. The other piece is, and you brought it up earlier, when you build a business that is sellable, that has high enterprise value, usually ends up being a really fun business to run. You can almost retire from the business without having to retire, right? I think to a lot of people that feels like a pipe dream, and frankly, it's a lot of work and time, but it can be done. Vital has a path to doing that. There's a lot of other companies that have a path to doing that. You can go do it on your own if you learn enough about what's needed and you execute. But I think in both of those cases, what occurs to me as I look at this from 10,000 feet is, these institutional investors are coming. They're coming into the business.
Yep.
They're going to disrupt the business. There's no doubt about that. They already are. They're going to disrupt the business. The best defense for the independent is offense, right? It's to run a great business. And I think if we look historically at all the other home services that have been disrupted by institutional investors, there's still a lot of very successful independents, right? You think about the plumbers, you think about the pest control, the water restoration. That's another one that's had a ton of institutional investment. There's still plenty of successful HVAC contractors. In fact, a lot of them. So you look at that possibility of success through this disruption. The one common factor is you got to be running a healthy business. Got to be running a healthy business. If you're not, then the chances of you really thriving through this experience are much, much lower.
Right. I think that's the key. It's like they're bringing professionalization. They're bringing competitiveness to the marketplace. They're not guaranteed to win, but what they are guaranteed to do is win if you don't step up your game.
Yeah. So what are the things that, I've witnessed this. We witness this a lot in the security side. I mean, look, there's another example of lots of institutional money, right? I mean, I ran a very healthy, successful security company despite, having to compete with all of the big guys, right? And so what are some of the great things that come to a marketplace or what are the great things that an independent dealer can expect to see, the good things from institutional investment?
Well, and I realize I also need to expand institutional investment one step further. The franchise model is a type of institutional investment, right? Yeah. We're seeing that, with Daisy. Savvy was in a franchise until they stopped.
There's also Listen Up, which is another one.
Listen Up's another one. There's a few of them out there. That's another way to think of institutional, is because it's the same impact in some ways. But what these companies do, institutionally, franchise, whatever, is they bring a professionalization to market access. What do I mean by market access? The marketing and the way they go out in the community around sales, customer engagement, and education. They're going to bring a lot of that. They're going to be in front of people. They're going to have advertisements. They're going to have people on the street. All of this. Why is that benefit for you? Because they're educating the consumer to your industry. Hey, we all know what the integrator is. 75% of America has no idea, right? They know Best Buy, maybe they knew Magnolia one day, but the concept of our industry is not obvious. That education is great. Now, and the key is they're probably going to go to the lower to the mid market first. As I pointed out by a lot of people, the custom is a little more difficult. But if you have this marketing engine that's not your dollars pushing this on that high end, you're going to receive some of the benefits. So that's one way. Like Matt, people know what security is because they see ADT doing their thing, right?
Yeah. And I'll tell you, you bring up a good point there, because there are plenty of shoppers in the marketplace who have no interest in doing business with the big gorilla or the large company. So as an independent, the better you can differentiate what you do from these larger companies, the more you'll succeed. Doesn't matter what industry you're in. If you're competing with the big guy, the beauty is you get to see all of the big guy's strengths and weaknesses, because it's a lot more public than you're independent. It's actually harder to compete with independents than it is the big, the big brands. So I think you bring up a good point there, that they're educating the consumer. One thing specifically that our industry has struggled with that other industries have done amazing at are service plans, right? Yet, in fact, today I have my HVAC company coming over at the end of this, actually, in about 45 minutes to do my annual service. They reach out to me and they make great money doing that. And there's lots of benefits to me as a homeowner. Pest control is the same. They come every quarter. I mean, there's a lot of industries who've really capitalized on this service piece. But yet, the custom integration industry has really struggled, right? I mean, there's some people that have a foothold. Well, the institutional investors are going to come in and really fix that. They're going to make that more mainstream, which is good for all of us. It's actually great for the consumer as well. So I think that's a benefit for the independent, is now these service plans will become more prevalent. And I think the fear for an independent is if I've been hesitant to implement some of these best practices in my organization, I'm scared because now I'm going to be forced to do those things or not survive. And frankly, that initially is scary, but who we get to become as owners through this experience is next level. We get to ratchet up, right? So that's what I'm looking forward to in our industry is a bunch of owners making the choice to level themselves up.
I think it's a great point. I think that is part of the professionalization that I mentioned before, and it's driving process and a higher level of service expectation from the customer. And if service contracts in integration are truly normalized, beyond what people are doing with Parasol or whatever, but if those are truly normalized, you now have real recurring revenue that is very valuable to both you on an ongoing basis because it accumulates. It's an accumulative thing. As you add customers, you add more revenue. As you add more revenue, you add more customers. To both you and any potential acquisitor, like driving that expectation of the consumer is going to be a huge benefit. But you got to take advantage of it.
Yeah, and I actually think there's a benefit to the consumer.
For sure.
I mean, there's a lot of consumers out there with technology systems they've purchased from an integrator that are broken.
Right.
Period. In fact, that's one of the black eyes that our industry has always dealt with is just stuff that doesn't work, right? Mm-hmm. And I think a big part of that is because when I was an integrator, I used to compete with smaller integrators, and I would say, hey, look, that's great that this guy answers his phone call every day, every hour, whatever the case may be, and we have some boundaries around what we do. The reason we have boundaries around what we do is because we know that we can continue to execute at a high level over time. What that person hasn't yet figured out is that every time they do a project, they have created more service calls for themselves, mm-hmm. right? But they haven't figured that out yet. And the reason I know that is because they're willing to answer their phone anytime, any day, right? But once they get to a point where they have too many free service calls to handle, you're going to stop hearing from them. And sure enough, that's what happened, right? And it's because integrators just haven't been running healthy enough businesses to invest back into their service or their team or things like that, right? So I think it's going to be very interesting, the transition in our industry, because I believe that consumers have been begging for more and they're going to get more. And I think it would have happened whether or not the institutional investments come in, but I think that's going to improve the industry across the board.
Well, I also feel that when that occurs, we're also going to see a lot more homes be willing to have these systems, right? Like I think that I know a lot of people, a lot of my friends who are just going to buy Sonos at Best Buy and plug it in because that's easy and they don't want to mess with anything. And they don't know how to get it done. They don't know who's going to support it. But if all of a sudden there's a support level that you can count on and trust that's going to keep your system running well and make sure that everything works, make sure your remote works properly, it becomes an easier buy. It's not just that that's your sales process becomes, oh, of course I'm going to do that. I'm not just going to buy a stupid Ring doorbell. I'm going to do work with you. So yeah, I think there's a lot of benefit to that. I want to talk about some of the reactions that I've heard and how it's this change in mindset from fear and fight to learn and grow. And I think, because I hear a lot, oh, why are you going to talk to them? You shouldn't let them in the door. We're going to not do business with that organization or this organization. You can hear that from manufacturers. You can hear it from buying groups. You can hear it from integrators. And it's like this, you're trying to hold back the dam, right, from breaking. Problem is it's already got a leak. And once your dam has a leak, it's going. So better off just getting the boat, right? Let's ride that wave of water coming downhill. Because I think that's what you have to think about is why is this disruption creating an opportunity for me to be better, grow more, and become more successful over the coming years? Because it's here. Mm-hmm. And that's the change of mindset that needs to happen among a lot of people.
Yeah. And I think you're right. And I think the mindset shift really is from one of scarcity to abundance, right?
Great.
Scarcity means if that guy wins, I have to lose. Or if I win, that guy has to lose. And the reality is that I think one takeaway we have from this experience of them investing in our industry, they see something in our industry.
Right.
They're not going to put all this money in time and effort into our industry if there isn't some upside, right? So I think that's one of the learnings and takeaways is like, hey, what are they seeing that we don't? Maybe we should learn from that. But also that shows us there's actually more abundance in our industry than we think, right? We've been operating in this scarcity mentality, like, oh, if that job gets won by this dealer, that means I'm not going to win it. Well, that might be true for that one job, but are we expanding our marketplace? I mean, I think that's ultimately what a lot of these institutional investors are doing is they're trying to expand the marketplace. They're not trying to rob, jobs from all of you integrators, right? The independents. So I think that's one of the other things to look at is how do we shift from you win, I lose, or I win, you lose to how do we all win together? Because ultimately, I think that's what our industry's been missing. There's a lot more opportunity than we've been tapping.
Oh, that's such a great point, Matt. I think that point of they see something here that they want to tap, that they want to take advantage of. Everyone's got to figure out what that is in their own market. But they see a growing industry that can become a engine of growing from maybe, what are we, like 5%? I bet they think we could be north of 10 if we expand the marketplace, do better marketing, better customer engagement, and do more. So how can you do more? How can you do more with what you have? And how can you become a better business person? Like, I'm excited right now. Like, this is the time when every integrator, every person in this industry should see that we are the best place possible to find that growth.
Yeah. And yes, and at the same time, I can see why there's so many people that are scared because they feel like they've been burning the midnight oil, doing everything they can to run great businesses. They don't see how they could get any better. And I think that's where that learning and growth piece is so important that you brought up. It's like, hey, it's time to step back and instead of trying to work harder, figure out what could you be doing different, right? We're always looking for the new when the reality is there's more and better that we should be doubling down on, right? Oftentimes we should just be doing more of what's working and not always searching for something new. So I think that's the big takeaway for me. And that's what we're sharing with our members to say, hey, we got to play offense here, man. Let's just continue to roll back our sleeves and do a better job with our businesses.
Yeah, and if the opportunity presents itself that the sale is right for you, because I don't think I know a single integrator who has told me, no, I never want to sell, right? If the sale is right for you, take it. Or take the money and do something else. That's great too.
Well, and the other piece I think that's significant before we wrap is there's sale and then there's taking chips off the table.
Oh, yeah.
So share with me, Brent, what you've seen as the difference between just an outright sale and taking chips off the table. What could that mean for an integrator?
So especially if you're dealing with a institutional private equity or institutional money coming in, make yourself valuable. If you want to keep running your business, they'll say, hey, we'll come buy your business, allow you to keep running it and own a piece of it going forward. Right? So you're going to have ongoing upside opportunity with their economics, right? Like their multiples and they're growing, but you're still going to have a job. You're going to be de-risked. You're going to have money in your pocket and you have an opportunity to be something even more than you are now. And look, I've spoken to a bunch of the Bravos guys and a lot of them are happy that way. They're still owners. They're still running their businesses, but they've made a really good money and now they have an opportunity to make money again.
Yeah. Yep. Yeah. So staying employed with the organization, like you said, making yourself valuable and having potentially a double dip or multiple dip exit, or just, taking some money off the table, taking risk off the table and having a great job, right? Not everybody's meant to be an entrepreneur for life. That might be an opportunity for some people as well.
It's great. It makes your life so much easier sometimes to have that steady paycheck without worrying about paying a bill, but also having that opportunity for upside that can change your life or your children's life.
Yeah.
So hopefully this was helpful for everybody out there. We covered a lot of ground. Anyone who wants to go deeper on this topic, please feel free to reach out. We can go help you understand how it could impact your business, how you can take advantage of it, and maybe help alleviate some of your fears. Because I think that's a big part. People are just afraid of the unknown, afraid of change, but change happens.
Yeah. Yeah, we don't normally do this, but to your point, Brent, if you want to reach out and have a conversation, send an email. Send an email to hello@growwithvital.com, or you can find me at any of the socials and you can DM me there at MJ Bernath at any of the socials. So yeah, reach out. We don't normally do that kind of thing, but this is important enough that I think we should do. We should communicate on any of these questions. Yeah,
absolutely. So thank you for listening to another great episode of the Flywheel Effect. Matt, any last thoughts before that? But I think this has turned out great.
Yeah. Our goals of education and also showing a little bit of that offense versus defense, I think we accomplished them.
Great. So until the next time, this is the Flywheel Effect. And as always, if you've liked this episode, please share it, like it, or give us a follow. And we appreciate it, and we'll hear you the next time on the Flywheel Effect. This is Brent Sonnek-Schmelz and Matt Bernath. Bye-bye.
Thank you for tuning in to the Flywheel Effect. Our journey through the intricate world of luxury home services continues to be fueled by your passion for excellence and innovation. If you found value in our conversations today, don't forget to follow us wherever you get your podcasts. More insights and resources. Visit us online at growwithvital.com. Until next time.